Voice joining us now. Manishi Ray Chaudhary joins in on the phone line. Manishi, how do you explain what we've seen happen in the last, 30 minutes of trade or so?
Well, difficult to explain these short-term movements, because there's obviously no fundamental reason behind them. If you look at the entire Asian universe today, they were actually quite disappointing, partly because of the weak PMI data that came out of China. And I think that was reflected most in Korea and Thailand, if I'm not mistaken. And I think, part of that is playing out in India as well. Though, as Anuj was saying just now, that it could be partly because of concentrated selling, but it's difficult to figure out any fundamental reason for, such short-term movement.
How much importance would you give it, Manishi?
We don't really attach too much importance to these very short-term volatility because I think it's better to look at slightly longer-term, direction of the market. But at the same time, as I've been saying over the past few weeks, actually, that the Indian market, as a consequence of the most recent outperformance, had actually run slightly ahead of itself. But particularly in terms of valuation, it was trading at significantly above the peers in this region. So I think that valuation correction is beginning to set in, as it has been for over the last 2 or 3 weeks. You've seen the market consolidating at the current levels, and I think it may continue for some more time.
Manishi, hi, good afternoon. The bull market corrections can be quite sharp and vicious. Do you sense that since we haven't had one correction for a long time, from 5200, the Nifty has had a one-way journey, something maybe 5 to 10% correction could be on the anvil, and today could be start of that. Is that a possibility?
I would think that could be possible. There are a couple of reasons behind it. We are still in the midst of a relatively tight liquidity situation. We have seen very sticky inflation persist, and even though the RBI did not hike rates in the last monetary policy, but they have clearly hinted at the possibility of further hikes if the sticky CPI inflation persists for longer. That's reason number one. Second, I think in the upcoming result season, starting from mid-January, we are likely to see some more downgrades to the earnings estimates, and this would probably come more in the cyclicals and to some extent some of the non-cyclical sectors as well. So I would think these two factors can actually lead to some more correction in the market, and which would obviously in the longer term set a better base for investors to enter this market, because by that time I would think that the valuation difference between India and its peers would narrow down significantly.
So Manishi, what would be 3 or 4 stocks that you will buy on a 5 to 10% dip?
It would be a combination of the beneficiaries of the strength in exports that we're seeing, and the relative strength in rural consumption, and possibly some of the the domestic cyclicals as well, particularly in the private sector banks. So among the exporters, we obviously continue to like IT services, and also the merchandise exporters like autos, like Tata Motors, or some of the rural consumption players like ITC and Mahindra. And among the private sector banks that I talked about, I would think the likes of HDFC Bank, ICICI Bank, or Axis Bank would possibly fit the bill. I mean, I would qualify that thing about private sector banks by saying that one must concentrate on those which have a very strong liability franchise, or in other words, which have a strong CASA deposit percentage, which would not make them dip into wholesale deposits, because the wholesale funded banks would still continue to be under pressure as far as the NIMs are concerned.
Manishi, Anuj was talking about 6350 as a resistance level on the higher side. In such, short-term volatile swings, what can we expect to be the floor of this market? Will it hold at 60 to 100?
Here again, I'm perhaps not really qualified as a fundamental analyst.
No. Well, more to say, just to give us a sense of when such short-term swings take place, how deep can they be?
If you look at history, even longer-term history, like last 5 or 10 years, and typically, if you exclude the periods of very sharp correction or the proper bear markets that we've seen during these phases, I would think, from the peaks, anywhere between 8 to 10% would possibly be in order. So the recent peak of the Indian market, which was about 21,000 on the Sensex, from there, one could possibly count about 8 to 10% on the downside, which would be a combination of about 3 to 4% earnings downside and about 5 to 7% valuation correction.
So does this smell like that, or too early to tell, or just a one-day phenomenon, or is that what you expect, let's say, between now and the end of earnings season?
Oh, definitely I'm not talking about just 1 day or 2 days.
I get that.
The kind of movement that I talked about would obviously, prolong throughout the result season, over the next 1 to 1.5 month period. So there's not going to be an overnight phenomenon by any means.
No, of course, I'm saying, do you sense this is the beginning of that at all, or is that too early to tell at this point in time?
Well, as I said, I expect this consolidation phase in the Indian market to continue for some time. Now, whether this is going to be 1 or 2 weeks or 1 or 2 months or even longer, that's, frankly impossible for any fundamental analyst to comment on. But, the valuation gap that I talked about, that would possibly need about 8 to 10% correction to get bridged.
Manish, is there a sense that the market got a bit too complacent? Because about, say, 2 months back, the view was that if the US yield crosses 3%, you will have a collapse in the market. You'll now officially have the start of the taper, and the market sort of ignored the news when it was announced. Is there a chance, and this rally has been liquidity driven, let's be clear about that. So is there a chance that the market maybe got a bit too complacent, and there could be one nasty shock which could be ahead for us over the next 2 to 3 months?
And just to add to that, the yield, the US 10-year has in fact held above 3% for the last 3 or 4 trading days.
For the last 3 or 4 trading days, indeed.
Right. It's a combination of many of these factors that you talked about just now. First of all, I think there was a degree of complacency that had set into the Indian markets. There was a combination of the macroeconomic numbers being slightly better than what they were historically, both in terms of growth and in terms of the current account deficit, which gave market participants a certain degree of false sense of security. We were, I think, ignoring the fact that we're not yet behind the woods as far as, or rather out of the woods as far as the industrial production numbers are concerned, as far as investments are concerned, and as far as inflation is concerned, which I think the market participants were kind of made brutally aware of that once the inflation numbers came out sometime in the second half of December. So that was reason number one. Secondly, I think, now that the taper of QE has been formally announced, there would obviously be some degree of contraction in the kind of massive liquidity that the emerging market funds were receiving till recently. So having said that, I think the kind of shock and awe effect that the announcement of taper had around the May-June period, I don't think that's likely to be repeated. First of all, it's not a major shock anymore. It's been analyzed and talked about and well telegraphed over the last few months. And secondly, even the external sector of India in terms of the current account and trade deficit is a lot better right now than it was about 6 months back.
All right, Manish, we're going to thank you very much for joining us to talk a little bit about what's gone on with markets since 2 p.m. That's Manish Raychaudhuri there talking you through the market consolidation move. Let's get